Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
So today the Fed raised the target federal funds rate by 0.5%. Mm-hmm. That is a pretty big raise.
It is. It's the biggest raise they've done in one shot in 40 years.
Okay. They normally do smaller basis points,
right?
25 or something,
right.
But they did 50, which is half percentage point. Mm-hmm. Okay. So the question everyone has out there, and we'll talk about a multitude of things with this, but the first question is, does this mean that when you call your lender tomorrow to get that mortgage rate, does that mean that it's going to be 0.5% higher?
Short answer, no.
Okay, so why is that? Let's talk about this. What is federal funds rate, and if and how does that affect the whole thing? Like, where does that fit in?
Okay, so a couple things. First of all, the federal funds rate is the rate that banks charge each other for overnight lending, so that immediately will impact things like short-term lending rates, like things like auto loans, personal loans, student loans, credit card, that sort of thing. Now, as far as mortgage rates are concerned, mortgage rates, if you've noticed, they started going up months ago, way before the Fed started raising rates.
Okay.
Why did that happen? Well, because mortgage rates are not tied to federal funds rate. And you're going, what? Okay.
Not even close, actually.
Not even close.
Yep.
So let's talk what they're really tied to and what I don't see anybody else talking about. They are tied to the 10-year treasury bill rate. So it's about bonds. It's not about the federal, the Fed rate, right?
Okay, before we talk about that, because I know what you're going to say, I'm going to put this chart up because they love the charts. They tell us more charts.
Yes.
Okay, so this is a chart of the 10-year treasury rate. This shows basically interest rates over the last 5 years. Mm-hmm. If you look at this, you can see that from 2020 to 2021, it was very low. This was during the COVID, when the COVID hit. The 10-year treasury rate fell. There was very little economic activity and very little home mortgage borrowing, like lending going on. Right. That did pick up, though, halfway through the year. It started to pick up, okay? Now, what's interesting about this is the amount that this went up, that rates went up like by 2.4% on the 10-year treasury rate, which is almost what they've gone up in the mortgage markets.
Right. So let's kind of talk about this a little bit. Because so the Fed started buying bonds, right?
Yes.
So here's the deal. The Fed is currently holding $9 trillion in bonds. Trillion. That's a big number.
The T.
Yeah. Right. So, but out of that $9 trillion, they have acquired half of that, $4.5 trillion in these bonds over the last 2 years. So this is what's kind of interesting. They've acquired half of this debt over the last 2 years. And the banks have kind of went along with this for a while, but by the end of last year, beginning of this year, the banks went, you know what, this is not cool. We're going to go ahead and start raising interest rates because the banks saw what the Fed just woke up to in March. They saw inflation. And the banks are super concerned that they don't want to loan money out and then get paid money back that is worth less than what they loaned out. Okay. So this is super important to understand. That's why inflation is such a big deal, and that's why inflation is actually driving the mortgage rates much more than the federal funds rate. And the reason that the Fed raised the federal funds rate is they're trying to dampen inflation. The reason that they're going to go ahead and try to sell off a lot of those bonds that they've acquired over the last 2 years is to suck money out of the economy. And by sucking money out of the economy, they're again trying to slow down inflation. By having less money circulating in the economy, there's less money chasing goods, and that will hopefully stave off further high inflation. So all of this is kind of working together in concert, and what the goal is for the banks to be able to loan out money at an interest rate that when the money is paid back to them, they're actually making money on that money, and they're not actually getting money that is less valuable than the money that they loaned out.
Okay, so let's talk about how the market and how the Treasury, the 10-year Treasury rate and mortgage lenders view this. Okay, so we have had for most of the last probably 4 or 5 years a target federal funds rate between 0 and 0.25%.
Right.
And then the banks basically get to negotiate with each other. And if you go online, you can Google it and search. You can see what all the banks lend to each other overnight. But it's all between 0 and 0.25. It's most of them are like 0.16, 0.17%.
Right. So to kind of give you perspective, there are places in Europe that have a negative funds rate. That means that if you put 100 whatever in the bank, you get less than that when you pull it out.
Japan has had this problem for a long time, and the problem has been that they have no tools to help grow the economy. And they had this problem for probably a decade. Okay, the federal funds rate, the first time it was raised, the target basically got pushed up to 0.33%, which is the current target federal funds rate. Now, of course, that's going to change that it's been raised. It's going to slowly start creeping up. Here's what's interesting. The market, meaning the lending market, the 10-year Treasury, and everybody that's looking, because the Fed has been talking about raising interest rates for a while, has priced in a 2.86% federal funds rate. So they're already priced in federal funds rates going up almost another 2 full percent.
Right.
So when you hear of more rates going, another 5.5, another 0.5, they're probably going to do this throughout the year. That doesn't mean that the interest rates are going to be 8%.
No, it doesn't.
But because the market is sort of ahead of this pricing it in, it doesn't react to it. Okay? Right? So, and like Wanda said, when the Fed, this is what's interesting. There's not a direct correlation between the change in the federal fund rate and mortgage rates. But this aggressive action by the Fed, which is an open market action, which is opposite of quantitative easing. They're not sticking money out into the thing by issuing bonds. They're actually buying bonds. They're selling bonds.
They're selling the bonds.
They're selling bonds, and then the money that they take comes out of the economy.
Right.
It just sits on the Fed's balance sheet as cash.
Right.
But it's not in the economy chasing goods and services, which is the problem.
Because remember, the Fed pumped all this money into the economy through stimulus checks, through buying bonds. So all of that money went into the economy, and that's part of what's fed this whole inflation thing, where we have lots of money chasing too few goods. We have too few goods partly because of supply chain issues and that sort of thing. The other thing to talk about is what the target rate for inflation is for the Fed. The Fed got a wake-up call in March when the inflation rate came in at 8.5%. For over a 12-month period. And remember, the Fed's goal is 2% over a 12-month period. So 8.5% over a 12-month period went, you know what?
And that was not the core rate.
No.
The core rate was 6 and change.
Right, which is still significantly more than their 2% target rate.
Because there are other things that the Fed doesn't include in that in their target, because they're largely outside of their control. Energy and things like that, food, things that change but always come back to the market works on those to bring them back in line.
Right.
So they can't just react every time energy costs are higher, food costs get out of line, because then they're causing other problems in the economy.
Right. But to your point, as far as food costs are concerned, I think food costs is something that I think everybody's a little bit concerned about at this point, because we are going to see very likely higher food costs going forward over the next probably 12 to 24 months.
But isn't that more of a supply chain than anything else?
It is, but that really doesn't make any difference when you go to the grocery store.
Right. No, you don't care. You don't care. And
Right. So that's going to be a concern, and I'm sure everybody's heard about it. But just kind of short story is, the higher price of seed for farmers, the higher price for fertilizer for farmers.
Well, let's talk about fertilizer. That's actually a huge thing. Fertilizer is the most expensive it's ever been.
Right.
And farmers, the problem with farmers is farmers are planting stuff they can make a profit on.
Right.
And they not necessarily planting things that that we need. They plant whatever they can make the most money on. And if we need wheat, but we don't make, but they don't make much money on that. They make money on corn and soy. They plant corn and soy.
Right.
So now we end up without wheat. Wheat is, creates a lot of products.
Bread, pasta, things we all like.
Bread, pasta, things people like to eat. So there's obviously other things happening. So the whole point here, the reason why we did this is because to understand, we talk about this thing ceteris paribus, all other things being held equal. We believe that the thing that's going to most fix inflation is not what the Fed is doing with interest rates, but this aggressive action by the Fed to sell these bonds. There's $9 trillion balance sheet. They want to shrink it by as many as $95 billion per month.
And we don't know for how long, and we don't know what the end picture looks like.
And we don't know that they won't accelerate that. The bond rates are very attractive. They exceed inflation. So obviously they're saying, hey, look, if you'll buy our bond, we'll give you maybe 9.5%. That's like, hey, that's 9.5%. I'll take that. But you go, well, inflation's 8.5%. Well, I'll take the risk. I'd rather put money into a bond that pays more than inflation because you're betting on inflation being less in the future.
Right. But, the economy is very complicated, and I can't stress that enough. So the Fed is selling these bonds. If people go and buy these bonds, that's great, but that means that they're not putting money in the stock market, or they're pulling money out of the stock market, and that causes a whole other chain of events. So the economy is super complicated. Now, the other thing to keep in mind is that the U.S. dollar is extremely strong. To give you perspective how strong it is, we were looking at it not that long ago against the British pound, for example. So it costs $1.30 to buy a British pound. Not that long ago, it was $1.45, $1.50. A few years ago, it was like
$1.60 or $1.70.
$1.75. So it gives you an idea of how strong the dollar is. That impacts how much our goods cost in other markets. And so with our goods costing more in other markets, that means that we have less exports. So the economy is just has so many moving pieces that it's really hard to say any one thing will do massive things to the economy. It is a very complicated thing, and we're trying to address some of the things that everybody's hearing about in the news and seeing in social media, and we're trying to also give you perspective that the economy is so much more than that. So just kind of keep in mind so that you're not sitting there going, oh my goodness, interest rates are going to go through the roof just because the Fed raised their overnight lending rate. There's much more to it than that. So please don't panic. That's the point.
Our intent here wasn't to do a whole class in economics. It was to talk about the housing market and how the actions that the Fed makes affects interest rates and what things actually affect interest rates. We actually have some pretty good videos lined up that we're going to do where we talk more about this historically and look at this, because there's a lot of people out there that are rooting for the housing market to collapse. And every time the Fed rate goes up, the videos flood YouTube about this is the nail in the coffin. And it's funny because we've been watching this literally the exact same video for 2 years in a row. And they're not talking about anything other than like the negative news of the day. Everything's potentially the thing that's going to destroy it. And certainly rising interest rates it is one lever.
It is,
but there are other things happening simultaneously. Savings rates, spending rates, consumer confidence, these other things. And then, the thing Juana mentioned too was if you believe interest rates are going to be higher in 6 months, what are you doing right now? You're making that decision to buy a house because you know you're going to need to buy in the next year. So maybe you accelerate that move you're going to make to go get a house. Because the house today, even though it might cost more a little in the future, with a higher interest rate, it's an even more expensive purchase. So you just bite the bullet and do it today. And we all know in the market today, especially in Las Vegas, that we have restricted inventory. It's very low. Stuff comes on the market, even in the $800,000 price ranges, that those things, in 2 days are gone.
Yeah, absolutely. So the economy is what it is. There are lots of moving pieces. As far as the Fed raising the interest rates, that's not the lever that's going to impact you if you're buying a house. The lever that impacts you if you're buying a house is the 10-year Treasury bill, and that goes against the Fed selling the bonds that they're holding. So if that's your concern, that's what you need to be watching. to figure out where this thing is going. Obviously, it doesn't take a genius to figure out that that mortgage interest rates are going up. That thing is baked in. How far they're going to go up, we don't know, but they're probably going to incrementally go up for the rest of the year. Inventory is still low. So long as inventory is low, housing will remain strong, because there are people who need to buy a house, because we all need to live somewhere, guys. So long as people need to live somewhere, there are people looking to buy houses. You know, if before you were looking at maybe 7, 8, 10 offers on a house, maybe with interest rates going up, you're not going to have quite as many multiple offers.
Maybe 4 or 5, but that's still not going to cause a collapse.
Right. You know, if your market time before was 28 days, if your market time before was 14 days, maybe it's going to be 28 days now. But the house will still sell. It'll still sell for a boatload of money. And it's going to be fine. We're not fans of the Chicken Little, the sky is falling. We are fans of data. This is the data that we're looking at. And we understand everybody's trepidation. Look, we have houses that we own, so we are interested in what's happening in the housing market. We have retirement funds. We have all the things that you guys have. So we are interested in monetary policy and how that impacts our lives. And that's what we wanted to share with you guys today. Tell us what you think about all this. Tell us what you think impacts the housing market the most. Tell us what you think impacts mortgage interest rates the most, and what's going on where you are, because we've said this a million times, real estate is hyper local. What's happening in your market? We want to know. We're interested. We're curious. We're obviously, data junkies over here. We love data. So any data you can provide, we're on board with that. Please, if you like the video, hit the like button, hit the notification bell, subscribe, leave us comments, and
we'll see you on the next video.
See you on the next video.
Bye.
Bye.